What they have done successfully, at least, is temporarily pull us out as quickly as they can, change laws, vote together, give us free money, open up the programs to open up the money to
Yeah.
get people to spend. And yes, that has trickle down effects. It has
Oh, yeah.
long-term horrible results, but in the short term, I never underestimate the government's ability to give us money to get us out of debt. And
Yeah.
so it probably won't get, even if banks fail, as bad as it could, because the government is going to do something about it.
Last week, we learned that Anna Kelly is preparing for a pretty nasty recession. Last week, I told you that I'm leaning towards a rolling recession, which won't be as deep, but certainly will likely be longer. There's a lot of people talking now, even Goldman Sachs, saying, folks, the great recession that's been called for just isn't going to show up. We're gonna cut rates. We're going to add shock absorbers to the economy, and we are going to have the 1994, soft landing. So I thought we should talk about inflation. We get a CPI print tomorrow. I thought we should talk about GDP, retail, consumers, because it is wild out there. Anna, what's going on?
Great. I'll just clarify one thing. I'm not necessarily calling for a nasty recession, but I think you
Okay,
asked me what's like the lowest I thought the Fed could go, and that's
got it.
dependent on if we have a nasty recession. So if it got really bad, if banks start to fail and they are much closer to crisis level than most people know, and I know this from deep, deep data, right?
Mhm.
They're the guys that used to be the head of the FDIC, guys that are at the IMF that research banks say we're a category 4 to 5 away from 500
Ooh,
banks, collapsing in the next 12 to 24 months. And that's more than collapsed 2009 to 2012. So if we have a banking crisis and they will be quietly merged most likely. It's not
oh
going to be
yeah.
announced that this is the savings and loan crisis 2.0, but if we start to see more distress in banks, regional small banks that really are how the government has pushed money out into small businesses and real estate for years and years and years. If those banks continue to be distressed and their bond values have to be rolled off, they take back more commercial real estate like we talked about number in one, that creates such a major drag on the economy and a counteractive balance to potential growth that it could keep the economy really flat, if not deeply recessionary for a long time. So I'm preparing for that as a possibility in which the probability of that happening is much, much higher than most people
Yeah.
think.
It's not
But
not
I
zero.
also
It's not
it's
zero.
not zero. But I also, and you and I talked about 2 years ago, we started talking about this idea that this very well could be a rolling recession. And in many ways, it has mirrored that pattern where you have sectors that are recessionary. But
Mhm.
one thing, for example, manufacturing was in a recession, it still is, but healthcare has boomed. Government has hired a lot, and so has healthcare. And then you got all these wonder drugs, right? And so you've got sectors that have come in and out, and you've got GDP that's just barely, is it going to dip? Is it going to go up? And it's just kept afloat because of this rolling type of nature. So I agree with you that it has seemed very much like a rolling recession, but the fact that the consumer is so much more stressed than what we were pre 2008. There's just a lot of consumer debt and very little savings. I
Let's
think that if
let's
you
let's
have
poke at that.
something,
Yeah.
just one thing. I think if you
Mhm.
have something like a banking collapse where credit becomes tighter at the same
Yeah.
time that Americans already tapped out, that's going to really slow spending in the discretionary stuff. And I think it could be enough. 68% of GDP is consumer spending. And so if the consumer's tapped out and they can't get more access to credit, barring the government coming in and doing what governments do, giving us helicopter money, then it would be very depressionary, right? But guess what I think the government's going to do, Michael? They're not going to let it happen. They're going to do the same thing they did before if we have that level of distress and pump, pump, pump money in the system to keep us just out of recession or get us out of it and claim it's really quickly over. The question is how Is it just flat? Is it stagflationary? I've been saying that word for a while. You and I have
Yeah.
it may be. It may be a stagflationary rolling recession that never is technically scary, but yet it doesn't put the American people and our standard of living any better off than we have been, pre-COVID. So I don't really have a base case for this is what this recession's going to end up looking like. My base case is the consumer is stretched. They will become more stretched. There's a lot more things that can happen that could be worse than we think because of how stretched that consumer is. And so I think we have to recognize that as a possibility. Opportunistically say, if it does happen, okay, here's how I'm going to hedge and make money. And if it doesn't happen, great. There's always places to make money. But anyone that is as old as we are
Mhm.
not, we're like 50 years young, right? But anyone that's as old as us or older should have gained the wisdom to say, we do not know where it's going to go. Here's what we think the data showed us could happen, and we have to prepare for that. But
Mhm.
your guess is as good as mine, whether we technically are even declared to be in a recession, or whether the proverbial soft landing is claimed, despite the fact that the consumer is in a much worse position than we were 4 years ago.
Yeah, I think there's a lot there that you gave us that I'm going to start watching, and specifically around the banking crisis, because again, the banking crisis, 2.0, should it come to be, again, given historics, we will see announcements Friday after the market closes. That's just when it
Yeah,
happens.
yeah,
And it's a known thing. We can follow that. To date, I think there's only been two really small banks that have gone. And again, I think you're absolutely right. These will be forced shotgun marriages,
yeah.
right? So these
And they
won't
don't
just
tell you
disappear.
that.
Oh
They
yeah.
don't tell you that. We have a bank here, a regional bank called Fulton Bank. They've been one of the biggest lenders of commercial real estate and PPP loans and small business loans in our region in Pennsylvania for years. And there was a quiet announcement that came out to us customers. We're merging. We're
Mm,
merging with another bank. It didn't say we're failing, but if you look on, the websites and guys like Rebel Cole who actually track who's in distress, who are the regulators looking at, they're one of them, right? But it
mm,
wasn't announced. So it's not in year two, but it's there. And so
yeah.
more and more the banks are trying to help, quietly negotiate buyouts and rescues. They're just not going to call them
Yeah.
that because they don't want the American public to think there is a crisis and pull deposits. That would be,
Yeah.
self-fulfilling
Yeah. We
prophecy.
we don't need that again. We saw what
Yeah,
happened with Silicon Valley Bank and First Republic and all of that. Yeah.
right.
No bank runs. We have all these apps on our phones. It's really easy to move money these days
Yeah,
and cause a bank run in 24 hours, as we've
yeah,
seen. So the second thing I want to talk about is that stretched consumer. And I want to talk about this under the lens of falling rates. And I just want to play out one particular domino track that might happen, which I'm not going to call good or bad. I'm just like, this could happen. So let's just play the game. Rates come down 100 basis points, 200 basis points by the summer of next year. So not quick, but a quarter point here or there. And bingo, bango, we're down 200 basis points. There is, last time I checked, $18 trillion in tappable equity. The consumer, in my opinion, is rather predictable. If rates get low enough, we will see cash out refis explode. We will
yes.
see HELOCs explode. And that's trillions of dollars of savings, dry powder, spending, consumption that could be unlocked in the next couple of years. What do you think about all that?
Yeah, that's very true. And that is part of why when you talk about, just going to the rolling recession base case, right? That I do think that that is a very real possibility because consumers that are tapped out right now, they're at the interest rates that they are, refinances are not happening that refis aren't, but home equity
Mm,
loans are still not happening that much.
right.
But
Mm,
there are programs that the federal government is pushing to allow people to tap, for example, $10,000 of your equity without an appraisal. Well, if someone's got $10,000 in credit card debt, they're like, yes, sign me up. And they add that as an equity loan without an appraisal and they roll the costs in. And that's great. Is $10,000 going to be enough? Right. So, but that does, to your point, give people an option if they own a home. And what we're not really good at as economists in the United States and published data is how much of GDP and spending is currently being done by people who are owners or who are renters, who
Exactly.
have
Yes.
certain levels of income versus others, right? And so the people that don't own homes, they're going to struggle for years. It just is. They're already 70% of US people, 67 to 70%, depending on your surveys, live check to check. 50% of those have less than 500 saved. So they still have to, if they own a home, they got to qualify for the mortgage. And if they've lost a job or their income's down, they may not qualify for it, even if the equity's there. That's why you see forced selling in a recession, because the banks pull back. So if the federal government opens up the floodgates and says every homeowner, no matter what their financial condition, needs to be able to tap 10, 20, $30,000 of equity, then the banks aren't going to lend it to you, right? So it's hard to necessarily qualify for those home equity loans. But what we have seen, and I have, I've looked at tons of data, we've talked about this on the show, is a very bifurcated economy.
Yeah.
We have the upper class, we have the lower class and the middle class in terms of income level. And those that are at the lower and middle class, they have pulled back. Many of them don't own homes right now. A lot of the middle class does, but the lower income doesn't. So if the lower income isn't spending, the middle income are hesitant, especially if they're W-2 workers and you do have a recession, they may not tap as much as they could. But guess what? The upper echelon of the money, they're still going to spend money. And in those sectors, you're going to have slightly positive GDP, even if most of the people can't. So it could keep it rolling. It could keep it going for some time. And it could be what keeps us from technically going into a deep recession is the government. What I have learned is every time I've thought it's going to be bad, right? It's rarely as bad as I plan for. And I'll say that I've said on this show, I'm conservative because I have been blindsided. So now I'm like, okay, the probability's higher. What we know for
PTSD.
sure
PTSD.
what we know for sure is not what gets us. It's the things
Yeah.
that we think we know that we
Right.
don't because we don't know what else could happen. And so
Right.
I think to that point, you kind of plan for the worst, but the government has gotten, I'm going to get hate for this. They've gotten better. I'm not praising the monetary and fiscal policy of the United States. I think they've created a lot of ups and downs that never would have happened if they would have just let,
Yeah. Let it cleanse. Let it clean
let it
itself.
play, let it play as it's supposed to, right? Let markets do what they're supposed to do. But what they have done successfully, at least, is temporarily pull us out as quickly as they can, change laws, vote together, give us free money, open up the programs to open up the money to
Yeah.
get people to spend. And yes, that has trickle down effects. It has
Oh, yeah.
long-term horrible results, but in the short term, I never underestimate the government's ability to give us money to get us out of debt. And
Yeah.
so it probably won't get, even if banks fail, as bad as it could because the government is going to do something about
Oh,
it.
yeah.
So
They'll do another
that's
bank
why
term
my predictions
funding.
are out the window, right? I think
Yeah.
they'll do it. I mean, if the recession gets bad, we're going to see more QE, we're going to see low rates, it's going to stimulate the economy. We're all going to think it's better, but then a few years down the road, someone's going to pay the piper with national debt and treasuries
Yeah.
are going to go up and all that. So I don't know what's going to happen, but I can guarantee you the government's going to put their hands in it to make it not as bad as it could be.
Yeah, where I'm going with this, that kind of domino series is it, and you said it, but I want to say it again. The asset owners win. And again, even today in the US economy, roughly 67.2% of folks own a home. That's roughly the home ownership rate.
Yeah,
That's more than 2/3 of the economy,
right.
just above 2/3. So again, what this really comes down to is inflation is a feature, not a bug.
Yes.
Asset owners win, non-asset owners lose. If you are currently a non-asset owner, your job is to figure out how to become an asset owner, whether that's stocks, real estate, businesses, whatever it is. And ideally, set up debt structure as long a term as you can. 30-year fixed is the best. So if you don't own a home, house hack, 203K loan, join the military, get a VA loan. There are lots of ways that you can get on the asset ladder. If you want to grow the middle class, get on the asset ladder. That is my big mantra for what I see coming. And that's the lesson I think of the last 4 years. Asset owners win, non-asset owners lose.
Absolutely. And I think the other key thing is there, if you want to do well long term, regardless of what the economy is, this is a time to really shift to long-term investing thinking, right? Don't bank on the value add. Don't bank on the quick appreciation. Don't buy alligators, as we like to say, that don't cash flow, hoping for upside and appreciation. Over the long term, properties appreciate, asset values go up. But the other thing is you've really got to lock in low interest rates as long as you possibly can, because theoretically, everybody's, said multifamily, go big or go home, right? We saw asset values fall 30% in a shift in economy that hadn't happened in a long time, but it can
Yep.
happen. But guess what? I'm holding my properties and I don't worry about it because I don't have to sell. So it doesn't matter what the value of the property is on paper. If it's cash flowing really well and you don't have to sell it, you just ride it however long you need to until the values bounce back from these cyclical things. To your point that inflation is a feature, not a bug. A recession is a feature, not a bug. So even though, the last video was kind of scary because it's like what could happen, I was like, it could get really bad, but it usually is short lived, right? So the great thing about owning real estate, why I bought another single family home this last year when I didn't find a big multi, is because I know I'm in an area that's undersupplied with good quality jobs. People would need a place to live. They're always going to pay me rent. It's going to cash flow. And guess what? Over time, you and I went back to that chart from 1970 forward at least. Asset values, inflation adjusted on a single family house, go up at least 1% per year. Over
Mhm.
time, you're going to be really happy holding real estate. I'm bullish on real estate. I still want more. I've got a lot and I still want more. And I'm going to buy more if we have hard times. So, yeah, buy assets. That's probably the most important takeaway we could say. Buy assets with low rate long term debt that cash flow. And over time, you're going to do really, really well and do it only in really great areas. I think that's the other really important part.
Awesome. Anna, where can people find you?
You can find me here on your show, social media, Anna Kelly, REI Mom, and for real estate coaching, consulting, and opportunities for accredited investors, you can find me at annakellyinvesting.com.
Anna, you're amazing. Have a great week.
Thank you. You too.